transactions, right?
Yes.
And also a secure anonymous publishing platform. I think some of us might know it already, others not, as you can say one or two sentences there. You're doing your PhD in South Carolina, and you will talk about the role of intermediaries in the crypto economy. That's new for me. I thought crypto economy is all about eliminating intermediaries, but a lot of new intermediaries are shooting up. So this is your stage, Robert. Welcome, thanks.
Thank you. And just one moment, guys, for getting the slides. So you get some So today, I want to, this is actually a topic that I didn't picture myself ever talking about when I entered the space. So I got into Bitcoin early because I really love the idea of a peer-to-peer money and disintermediating. Now, here I am helping grow a privacy coin, privacy platform, ecosystem, and talking about intermediaries. So what's going on? This is kind of weird, but also kind of cool. So I'll start off with a tale of two banks, or two jurisdictions. And this was from information we got this morning over breakfast, and last night with a friend who's complaining to me. So last night, a friend of mine who runs a big cryptocurrency mining business sent me a very angry text message or a picture of a PDF of a letter that he received from a major US bank that basically told him they're shutting down his accounts and will not be doing business with him. No explanation, just a unilateral declaration that they want nothing to do with him. And he was quite offended. He's a very upstanding guy. He's a former military officer. He thinks he's done everything really done things right with his life and contributed to society. And here he has a business that he considers, he's very proud of, he considers a very legitimate business, and this bank just unilaterally shuts him down from their services. So he was quite upset. On the other hand, I woke up this morning and over breakfast I saw a news article that an Israeli court ordered one of their banks to stop discriminating against blockchain firms. So there's one firm in particular that was lodging a complaint against an Israeli bank, and the court actually intervened and told the bank, you can't discriminate like this. So this is what we're up against, is a very heterogeneous response from different governments around the world. And I think that presents opportunities, but also has problems. Because the worst type of regulation is uncertain regulation. The best type of regulation, of course, has some utility, but is also very clear and easy to comply with. So what I'm going to talk about today is, initially, I'll just give you a quick snapshot of where I think we are in this whole crypto finance, crypto economy. And then I'll talk a little bit about some of the problems with that, because it isn't all amazing. There are some amazing, absolutely amazing, groundbreaking stuff, or things that we're doing, but we for sure have issues. Just some of the very classic economic issues, agency issues, information asymmetry, or whatnot. But I think that intermediaries could or should actually step into this market. In particular, intermediaries that currently exist in the traditional financial economic system that have scale and expertise across a range of functional areas. And I think this is a tremendous opportunity for them to enter the space and start taking advantage of opportunities to make their own businesses better, but also make this crypto economy better. So, let's see if this thing works here. I want to set the stage with a few charts. So, this is a classic chart. For any of you hodlers out there, you probably check CoinMarketCap every single day, or I don't know, 20, 50 times a day. The market's been crazy, right? The market actually exploded up into about $750 billion until recently, and we're kind of on a bit of a downward trend. Who knows if it's stopped? I'm not a technical analyst. I don't know if I even believe in technical analysis. But nonetheless, this just shows that there's a massive amount of capital that's flowed into this industry, at least on the valuation side. There is a huge crowdfunding explosion. This is the next two charts are from CoinDesk. They do a really good job of ICO data and venture data into the space. We just had a massive ICO from Telegram. Personally, I have no idea why they needed so much money, but they raised, what was it, $850 million, I think. So good for them. But if I were an investor, and I am, and I was asked to participate, I chose not to. I didn't quite understand why they needed so much money. One thing that investors used to care about was, what are you going to do with the money? You get some capital, and you should have a credible plan for why you need about that much capital to do something useful. Now we've had so much money flowing into the space, about $9 billion so far. It's been raising crowdfunding events, these ICOs or initial coin offerings, or whatever you want to call them, token sales. And I think that this represents, on one hand, a wonderful innovation in markets, that we're opening markets up to the crowd, to wider access around the world, and that's really cool. It's great. There are great benefits for kind of capital allocation. Now there are downsides, and the downsides I think we just need to be realistic about. I don't think the downsides being that this market should just be shut down. I think that we need to have a realistic assessment of what's going on, to think about how we can craft a good response, as individuals, as investors, as industry participants, as academics doing research, as regulators thinking about how to make these markets safer. On the VC side, if you wanted to start a company, even 5 years ago, you had a great idea, maybe you had a minimum viable product, and you would go and fund part of it yourself initially. There was the whole 3Fs, right? You raise capital initially from friends, family, and fools. And then you start considering your angel investors, and then you start considering VCs if you're doing really well and you're starting to show success. And each step along the way, you have to prove yourself and justify what you're doing, kind of plead for this capital. And the capital comes incrementally, not a huge sum up front. That's a vastly different process to actually have incremental capital flows into a business that is making kind of milestone progress. Now, these crowdfunding events are just kind of giving oftentimes kids with just white papers and websites vast amounts of capital that just doesn't really make sense, at least from the paradigm of a few years ago. But on one aspect that is interesting is that traditional venture funds are actually getting into the space, and they're pumping a decent amount of money in. So there's something going on here. We can't say that there's all waste, that this is all a useless bubble. There for sure is some value being created, and I think it's a little bit difficult right now to be able to kind of tease out the signal from the noise. But VCs are getting in, and you'll notice if you can actually see some of the numbers in this chart, I recommend go to CoinDesk, and you look at the bubbles here and the magnitude of the bubbles. Some of the biggest VC investments in this space are on the order of about $100 million. You compare that to Telegram, which just raised $850 million. So the professionals, whether they're right or wrong, or they really have some asymmetric advantage in this space, they're investing almost an order of magnitude less on average into startups than firms are able to raise through crowdfunding. But there is something going on. So just kind of a quick snapshot now to roll all of this together is I think we are in an age of crypto finance now, and this is what my PhD research is on. I think that this is something new. But there are old world problems that we have to just, again, be realistic about and think, how can we try to make things better? So we for sure don't have a perfect system. We know this. I don't think that any system is perfect, but what we want to do is at least point ourselves in the right direction and incrementally get better. So the big thing that I see and I always talk about is I think that we're Uberizing finance now, which is a really big deal. It may not seem like it up front. Like I said yesterday, an exponential process looks linear if you're close enough to it. So I think that there's something big going on here, and the process of Uberizing or kind of relegating a lot of finance, or even just certain functions of finance to a peer-to-peer process is tremendous and vastly innovative. I don't think that all financial functions will be relegated to a peer-to-peer process. So here's where the entrepreneurial opportunity lies, is to try to figure out what are the best functions of finance to kind of push out to the peer-to-peer level. So we are revolutionizing finance across a set of domains. It'll take some time to figure out which of these domains actually has the biggest disruption. Maybe there'll be a vast disruption on some of them, like even the concept of money, this issue of sending money across borders, remittance, asset settlement that takes currently 3 days from when you sell something to when you get the money. for that sale, which is kind of crazy in the 21st century. There's a whole bunch of domains here, venture funding, that are being touched by this industry. The verdict is not yet out of which will actually be massively disrupted, which might have some marginal improvements, which may actually be completely irrelevant to the industry. But there are some big changes that, from a philosophical perspective, I think are really cool. From a utility perspective, really cool. Like the idea that your private keys in this asymmetric cryptography actually represent, kind of like the old-fashioned idea of bearer bonds. Like you could show you owned a bond by actually holding the physical certificate. That concept went away in the 20th century, but now we're kind of bringing it back, where now people actually own and control their own assets or their own money with a private key. So that's really interesting. It also has some downsides. There's a whole bunch of utility that banks and governments and central banks provide with kind of assurance of funds, or in the US, like FDIC insurance. Your deposits are insured up to some number. We don't have that in this industry yet. I don't see any reason why the concept of insurance wouldn't apply to our industry. So don't judge too harshly yet. Cryptocurrencies for sure represent a new asset class. Or maybe I shouldn't say for sure. There are some academics who are debating this currently. It depends how you define an asset class. But if you just look at the return patterns from, say, Bitcoin, the return patterns have very interesting characteristics relative to other assets that we traditionally think about, like stocks, bonds, real estate. And the really interesting characteristic is that the return patterns don't co-vary with the return patterns of these other assets. That's a really big deal. Whether or not that holds over time, still to be determined. But at least for now, from 2009 or 2013, wherever you think the data quality is good enough to start measuring, the return patterns are beautiful from a portfolio management perspective. And there's just a ton of money flowing in. And the money's flowing in through different channels than it has previously. I've actually given this particular slide, I've been talking about in different iterations over the last year. And every time I update the slide, I'm kind of blown away, personally. When I first brought the slide, it was something like $67 billion in total market cap, something like, I think it was $2 billion raised in crowdfunding. So over just the last year, we've had $2 billion explosion to like $9 billion explosion in just these crowdfunding events. So things are changing. There are a lot of skeptics, and there should be skepticism. We should all be scientific and kind of agnostic about things. I love this industry from like a philosophical perspective, or why I got into it a while ago. I just love the idea of giving people freedom and pushing this peer-to-peer process across domains. But there are a lot of issues. Now, the skeptics, I think, are a little bit extreme. I put some very prestigious skeptics up here. Like Paul Krugman actually called Bitcoin evil. He's an economist in New York. And his perspective was evil because ultimately, if it were massively successful, could take power away from central banks. And if you caveat the idea that the world is better with central banks, then sure, this is evil. I think that's an extreme position. I think the world there will be different type of institutions that coexist with this space. Robert Shiller is famous for just always calling a bubble. I always like to say, in the US, we also have this term, like a rain dance. Native Americans in the US used to have this thing where, they wanted their crops to be watered, so they would do a dance until it actually rained. Well, it's the same thing if you're constantly calling a bubble. It's like you're doing a rain dance. At some point, it'll eventually rain. It may not necessarily be because you did the dance, right? So he's constantly calling a bubble. In 2014, he said Bitcoin's a bubble. That was a really bad call. At least as an investor, that would have been horrible to listen to him. 2017, he again called it a bubble. We are kind of coming off a high, so who knows? I mean, if you were entering a bear market, still again, TBD. Jamie Dimon from JP Morgan called Bitcoin a fraud. He's quite famous for doing that. I don't know if this is more of a publicity stunt or if he really meant that, because the rumor is, traders at his firm were buying Bitcoin at the time. And then Warren Buffett, Charlie Munger, the old guard here of fundamental Benjamin Graham style fundamental analysis, they hate Bitcoin. So Buffett says it's a joke. Charlie Munger went a little bit further and said the government should actively stamp this noxious poison out, from Earth, which I think is quite extreme. I personally don't appreciate it. I work my butt off every day to try to add value in this space, and I don't like it when someone who doesn't know what they're talking about actually comes down and condemns it that viciously. He even said there's no way he would invest in it because he doesn't understand it at all. I asked, why would you actually comment on something then if you don't understand it. I think that's a little premature. But there are some real problems out there. And here's where we need to be honest with ourselves. So there are huge inefficiencies in this ICO gold rush. I guarantee you there will be many of these ventures that fail. Now that's not too surprising. On the VC side, you would expect about 2 out of 2 investments to actually pay off really with nice solid exits. So sure, even if 20% of these ventures succeed, that's about on par, at least statistically, with what we would expect from the VC domain. So we can't be too harsh yet. I saw an article that maybe it's still, again, premature, but the other week it actually said, or claimed about 50% of ICOs have already failed or just gone dark. Basically, people taking money and stopped doing anything after they got the money. It's certainly possible. This stuff also happens in the normal startup world. Maybe we'll see some extremes here, because this is something new and there's a flood of money coming in. But I think the big problem is that a lot of investors don't know what they're buying. So I've had friends and colleagues just kind of ping me every now and then randomly saying, hey Rob, you have to get into this ICO, I need your money right now to get in. And that's not the way I like to invest. So I have no problem putting money into new ventures, but I'm not going to throw money into something I don't understand at all. But there are plenty of people that's their kind of modus operandi in this industry. If there's something that's hot, maybe they check out a web page or a white paper for 5 or 10 minutes, and they don't really understand the technology, where it fits in the space, they have no idea who the people on the team are, and yet they're still pumping money into it. Which in some sense could be rational. If you're pumping a little bit of money into something, you don't have to do a massive amount of due diligence. If you're pumping millions of dollars in, sure, you have to do much more due diligence. So we shouldn't always condemn everything as black and white irrational. There are reasons to do things. There are massive agency problems in this space, though. Principal agent problems, there's moral hazard. If people get the money, get a huge lump sum of money up front, do they really have the same incentive structure as you would get from an incremental funding model to actually do good stuff with the money? Or do they have more of an incentive to kind of maximize their own personal utility up front? Versus kind of the long-term utility of the firm that they're starting. There's at least when I first started talking about this subject, there were rarely any legal claims to what you were getting through a crowdfunding event. This is changing. So I have to say, at least in the US, now more of these crowdfunding firms are kind of going down the securities route, where they're actually getting lawyers, which is kind of weird, right? Acting like adults, getting lawyers, and giving some sort of equity claim, usually equity claim, which makes sense for this type of stage investment. But that's different, and it's not universal. There's plenty of these crowdfunding or ICOs that actually really aren't giving you anything if you look into the details. And maybe some of them call it utility on some future network to do something. That's a very dubious claim, I would say, to at least par with your money, at least to par with large amounts of your money. Now, from the asset pricing perspective, which is kind of my focal point for my PhD, was this asset class, if it is an asset class, does not conform to any asset pricing model that we know about. It just doesn't. There's no way to anchor valuations in any type of reality that we knew about more than 5 years ago. So you can't take a capital asset pricing model, or APT, or ICAPM, or any of these other models, and apply some sort of rational discounting mechanism to future cash flows. There's no way, right, at least for most of these ventures, like for mine, for instance, with ZenCash, there's no way to come up with some future stream of cash flow estimates and then rationally discount that to come up with a valuation number. So we have to think, if these things have a value greater than 0, which I contend is very likely, that they should be worth more than 0 in most cases, we still don't know what the number above 0 should be. Okay, and that's challenging from an investor perspective. There's no way to anchor this stuff in reality. Like that chart I showed you of the exponential prices and market capitalizations was maybe a function of the fact that we have no idea what valuation should be. Or maybe valuations should be 10 times what they are now. Maybe they should be 1/10 of what they are. Maybe something in the middle. Who knows? I bet these markets aren't really that efficient yet. Extreme volatility makes adoption difficult. We always think about, at least on the kind of like the entrepreneurial side of the space, we always think, how do we get people to use our products? How do we get people to use our cryptocurrency? It's challenging. So there is extreme volatility. Like any given day, you can expect a 20%, kind of standard deviation band around the price, which is crazy. If you're a merchant, you're not going to accept this type of exchange rate exposure. There's just no way. If your supply chain is expensed in US dollars or euro, there's no way you're going to take Bitcoin or ZenCash or something and just sit on it like a hodler. I mean, in best case, if we're going to do business with these people, we need to come up with automatic conversion mechanisms and make sure this is really just kind of like a payment channel, and that's it. And then it converts immediately to their own currency. And traditional assurances don't exist. And here's where I think that intermediaries and institutions have a role, is that there's no FDIC insurance. The insurance industry really is not entered the space at any significant scale. And why not? Right? So there are some reasons. There are some issues for sure, with storage, security, and all that, even regulatory uncertainty. But for sure, we know how to discount for risk. So premium structures could certainly be constructed that take just discount rationally for risk. So I think it's insane that more insurance firms have entered the space. That's what I'd like to see, actually. And there's currently no recourse to losing your private keys. I've done this. I'm sure anyone who's been in this space long enough is lost their private keys at some point, to at least some of their funds, and it sucks. There's no one to complain to, or you can complain all day long, but you're not getting your money back. So this is something that, why not have institutions come in and provide certain services for a fee? So I think that there's a role for intermediaries in a crypto future, and this is because not everyone is a crypto anarchist. So I happen to like to have full control over my own resources, but I don't think that the mainstream user does. So I think there's absolutely a role for intermediaries, but I think it depends on how they react to this. So reactions have been, I think, pretty poor, honestly, across the board. I've seen academic research, I've seen central bank research, I've seen institutional research, and I don't think they fully quite get it. And I can't say that across the board. But there are tremendous opportunities here, and I think that they need to look at the opportunities and not take a stubborn perspective like a mule where you kind of kick your hind legs in or refuse to budge and you just say this is horrible, I want nothing to do with it. I think that they need to look at this from the perspective of entrepreneurs. And if they don't, we'll do it. So any service that institutions don't come in and start providing, we're going to create ourselves. We already are. There's already vaulting services. I would rather see, though, more people come and participate, and as much of a anarchist as I may be, I think it would be really cool, at least for mainstream adoption, if we saw more capital from recognized institutions actually come into the space and try to do good, rather than kind of completely firewall themselves from it. The reality is blockchains don't solve everything. I think that there are lots of hopes and dreams in the space for a completely, disintermediated world. I think that a lot of people have preferences, though, for kind of trusted institutions. The whole point of this industry initially, and even from my perspective now, was to disintermediate and kind of remove trust from human beings, and I think that's perfectly awesome. I don't think that it is perfectly applicable to every human being. I think a lot of people, for whatever reason, like to have some large institution or group of people that they trust actually kind of helping them out. I think that this is a perfect, fee-for-service model that banks should consider. Business models in the past that relied on restricting access, I think are going to go away. Not initially, but if you think that your business model is going to be solid because you can restrict access in your market from new entrants, I think you're crazy. So what we're doing right here is we're creating a world that has open access, basically APIs to plug and play, to build things on top of it without permission from anyone. So the fact that we have kind of this wild, wild west environment is good and bad, but it exists. That's a reality. It's not going away. So I think that if you're sitting in an institution right now that has an asymmetric advantage because you can restrict access to licensing or some capital requirements or something, I think you're crazy. Absolutely, you have this advantage right now, but I think that over time it will go away. Maybe it won't entirely go away, but it will be chipped on. You'll be on the losing side of history, basically. Even the concept of money is being challenged, which is the oldest kind of moat that the financial industry or systems have had. Basically, governments or central banks have a monopoly on money. And they still largely do for the average person, but now we have something that is completely new. We've actually opened the concept of money up to free market competition. And who knows where it will go. I don't know whether it will be kind of like universally dominant over time, but if I had to make a bet between a monopolistic system that's unresponsive to consumers and a fully free and dynamic system that is constantly adjusting and evolving to consumer preferences, I would place my money on the dynamic system, and that's what we have. So again, we may not completely dominate or overthrow central banks like a lot of people in this industry want, But I think that we for sure will have an environment where both systems actually kind of coexist with each other, at least to some extent. So intermediaries have the opportunity to evolve with us. They can choose to kind of, do what this large American bank did and say no. Oh, okay. Yeah, I like to ramble. So, I had a quick chart here from an article I wrote last year with data. I think that went up through 2016. So this was the whole portfolio manager thing. So I wanted to give a few examples of how institutions could start playing right away. I think why I'm bullish on the industry is that more institutions and portfolio managers are realizing that the covariance is awesome, and basically an awesome covariance is zero. And they're realizing this. So I think institutions are almost mechanically going to have to start entering the space just to diversify their portfolios more efficiently. And this, I think, is a mechanical process that means we're going to have a significant capital inflow. Okay, so just the typical finance metrics of kind of Sharpe ratios, excess returns, changes to portfolios and whatnot. Even ex post changes to portfolios, we know have issues, but still, order of magnitude better with Bitcoin. And so what institutions should do, and intermediaries, is they should look for the opportunities, treat this like they're entrepreneurs, and look for, number one, they know that they have inefficiencies in their own models, so figure out how you can use the technology to improve your own inefficiencies. And a lot of them are going down this private blockchain route. That's fine, they can give it a shot. I don't know if it's much better than the database. Asset settlement, cross-border payments, we know there's a lot of inefficiencies. Look for the technology to improve. Some of them are. They're looking to partner with some firms in the space. But what they should do, first and foremost, is leverage their scale and expertise. They have a huge advantage over us. My organization, we have 50 people and a budget of a few $1 million right now at any given month. A massive institution could probably walk all over us if they wanted to in a particular area. We'll be scrappy though, and we'll find our relation and do really well. But they should try to take advantage of this. There's a whole bunch of services that I think they can provide, from vaulting to asset management, screening, monitoring, triaging, capital flows, and all that stuff. And I think regulators should think, how can they make their jurisdictions more competitive to attract capital and talent? Because this revolution is going on, embrace it, and try to use it to your advantage. If you want to have the best and brightest minds in society come to your area, come to your jurisdiction, open it up to them. Make the rules clear, concise, simple, not onerous. Okay, so I think that's the best type of regulation. Antagonism gets us nowhere. Let's work together. I think that for sure we're creating real value in this space. Don't try to stonewall it completely. Try to leverage it, and whether institutions or actually come in and participate, it's up to them. But these services aren't magic. We're going to create these services by ourselves if they don't want to. So they have an open invitation to come in and start adding value. If they don't, we will. That's fine. And I think peer-to-peer money, for sure, poses a challenge to philosophically to central banks. But I think that's okay. Embrace the competition. It's probably not going to wipe you out tomorrow. But don't try to stay in existence by preventing competition. And I think cryptocurrencies challenge government revenue models. Here's another very interesting topic. Maybe we can have a whole other talk on. But I think the governments need to think about fee-for-service type models where they treat citizens like customers. But that's a completely different topic. But this domain certainly opens up a whole new set of questions that we need to think about. So that's it for what I have today, guys. I think that we can work together to create a better society and try to create real value. So thank you very much. Any questions? I don't know if I have time. But